All right, thank you very much, and thank you for tuning into our channel again. My name is Abiola Fajimi, FCA FCTI, and today I want to talk to us about the new Nigerian Tax Act 2025. I'm sure a lot of us, you've heard about the new Nigerian Tax Act, and you are wondering what exactly is this all about. So, July 2025, the President of the Federal Republic of Nigeria, in person of President Bola Ahmed Tinubu, signed the new Nigerian Tax Act 2025 into law. And like some of you know, our president is a taxman. He understands that a nation can only grow when the citizens of the nation pay their taxes. So he signed this law into effect. And I will spend the next few minutes to just talk to us about what are the constitutes of this tax act. When we talk about the new Nigerian Tax Act 2025, what are the laws that makes up it? I will talk about the timeline for its implementation, and then I will talk about the key requirement of the personal income tax and also the key requirement for small businesses. What are the key things, or how does this law essentially affect small businesses? Nigeria has a low tax to GDP ratio of about 10%, which was considered significantly low compared to other countries that have an average of 15 to 20%. In fact, data shows that most developed countries have a very high tax to GDP ratio, and that's the only reason why they have been able to really develop. So the country had a low tax to GDP ratio of about 10%. There was also a widespread tax evasion and avoidance. A lot of Nigerians were not paying taxes by the time he came to power, and there was a general poor tax compliance. People were not interested in paying taxes, and we also have a tax system that was considered to be very complex with a lot of taxes. Over 50 tax legislations we had in place. So when we talk about the tax acts, the Nigerian Tax Act, we essentially are talking about 4 laws. There are actually 4 acts that make up the Nigerian Tax Act 2025. And I will quickly summarize the requirement or the coverage of each of these laws. And then in subsequent video, I will take us through the detailed requirement of some of them, so that as a taxpayer, you can be familiar with some of the requirements of these laws. So first is the Nigerian Tax Administration Act. The Nigerian Tax Administration Act essentially talks about or contains the requirement for the management and running of Nigerian tax systems. It talks about the responsibility of the tax authority, the responsibilities and power of the tax authorities, the responsibility and the expectation also from the taxpayer. So it essentially contains the framework for the management and running of the Nigerian tax system. Then we have the Nigerian Tax Act. The Nigerian Tax Act 2025 is the proper law that speaks to the taxes that you need to pay in Nigeria, the taxes you need to pay on different kind of transaction, the amount, the debt that is due, and who and at what point do you even need to pay those taxes? What are the essential things you need to do as a taxpayer? So it contains the law and the details of the taxes that you need to pay on the various transactions as a taxpayer. That's what we have in the Nigerian Tax Act. And then we have the Nigerian Revenue Service Establishment Act 2025. This is a law that now establishes what we call the Nigerian Revenue Service. Nigerian Revenue Service is a new umbrella body that is replacing the old Federal Inland Revenue Service that we are all used to. So in 2026, we will not have Federal Inland Revenue Service, which is the body that collects federal taxes. Rather, we will have Nigerian Revenue Service. That Nigerian Revenue Service is established by the Nigerian Revenue Service Establishment Act of year 2025. And the Nigerian Revenue Service is now going to be the umbrella body for collecting all federal government revenue. All the federal taxes and levies will be collected by the Nigerian Revenue Service. Then we have the 4th one, which is the Joint Revenue Board of Nigeria Establishment Act 2025. Joint Revenue Board of Nigeria Establishment Act 2025. This act essentially establishes three bodies for the administration of taxes in Nigeria. Three other bodies. One is to establish the Joint Revenue Board. It established the Joint Revenue Board, which is the body that comprises of all the state tax authority and the Nigerian Revenue Service. So all the tax collectors at both the federal and the state level sit in this body. That is the Joint Revenue Board. Then it also established the Tax Appeal Tribunal. The Tax Appeal Tribunal deals with any dispute that may exist between the tax authority and taxpayer. Any unsatisfied taxpayer has power to approach the Tax Appeal Tribunal to adjudicate on any tax related matter, and it carries appropriate power of a court so to adjudicate tax matter. And we'll have the Office of the Tax Ombud. The Office of the Tax Ombud is there to support the taxpayer in case of dispute with the tax authority, not just going to the appeal tribunal. You can approach the tax ombudsman to help you mitigate, mediate or resolve any dispute you may have with the tax authority. So this has been, this office, this act recognized the need to have this office of the tax ombudsman to help in resolving any dispute that may exist between the tax authority and the taxpayer without going to litigation or adjudication. That is the purpose of setting up that. The whole act will be effective from 1st January 2026. So come 1st January 2026, we'll have this new act and we'll have to comply with it. Businesses will have to comply with it. The impact will vary from organization to organization depending on the nature of your business and the complexity of what we do. So let me take you through some of the key requirements for the personal income tax under the new act. And I know a lot of people have been wondering what would be the personal income tax computation, what will it be like under this new act in 2026. So under the new act, the new tax act 2025 introduced the new personal income tax table. So your personal income tax table will change effective from 1st January 2026. We have a new tax table and you can see the tax table right there. Going forward now, your first 800,000 salary or income, personal income, does not attract tax. It will be at 0%. So if you earn less than 800,000, you will not pay tax. Then the next 2.2 million naira will attract tax at a rate of 15%. Then the next 9 million will attract tax at a rate of 18%. Then the next 13 million will attract tax at the rate of 21%. And the next 25 million will attract tax at the rate of 23%. And anything that is above 50 million is going to attract tax at 25%. So how do you do that? It means that when you look at your total income, the total personal income you are expected to make, you will break it down. Your first 800,000, you put tax 0. The next 2.2 million naira 15%. The next 9 million 18%. The next 13 million 21%. The next 25 million 23%, and above 50 million 25%. So that is how you are going to graduate your income. Depending on where your income finally terminates in this graduation, that's where you stop. So if you are somebody that maybe you earn 5 million, for example, it means that you will say 800,000, 2.2 million, and then the balance is going to be 2 million. That will add up to your 5 million. So, and you put your rate against that amount. Also, in terms of relief on your income, on the income you earn, you are allowed to deduct the following before you arrive at actually your taxable income. Your total income less some of this income relief will give you your taxable income, and it is on that taxable income that you are going to apply the tax table. So the relief allowed or available for you are now one, rent allowance. Before we used to have consolidated relief, you no longer have consolidated relief. What you need have now is rent relief. Your rent relief replaces the consolidated relief before, and the rent relief is the lower of 500,000 or 20% of your annual rent paid. So you can only deduct from your total income 20% of your annual rent you've paid, whatever rent you've paid. If you are paying rent, if you are not paying rent, then you cannot deduct anything. So you will deduct 20% of the amount of rent you've paid, and it's subject to a maximum of 500,000. So you cannot deduct more than 500,000. If you do a reverse estimation, that means that we are talking about you being able to you are talking about the fact that once your rent is more than 2.5 million, you cannot deduct more than 500,000. And when you want to claim this relief, you will need to provide evidence for the payment. You will need to provide receipts for the rent you have paid for the tax authorities to allow you to be able to deduct it. Another change that has been introduced is that when you are using the company assets, if you are using company assets, it is deemed that you are earning it as benefits. If you have official car, if you are living in the company's apartments, the tax authority will tax part of that benefit. They will tax an equivalent amount that is equivalent to 5% of the amount of the asset, of the value of the asset as at the time of acquisition, will be deemed to have been part of the benefit provided to you and will be added to your income. So whatever is the value of the company assets you are using, the tax authority is going to add 5% of it to your income, and it's going to be part of your income that will be taxed. Also, if you pay pension will be allowed. You'll be allowed to deduct your pension from your total income before arriving at your taxable income. You'll be allowed to deduct your pension. You'll be allowed to deduct your National Housing Fund. You'll be allowed to deduct your health insurance, HMO. You'll be allowed to deduct your life insurance. So if you pay any of those things, you'll be allowed to deduct it from your gross income. From whatever is the gross income that has been determined by your company, you will be allowed to deduct all of these before arriving at your taxable income. And it's upon that taxable income or chargeable income that the tax table will be applied. Income tax table will be applied on your chargeable income as an individual. And it's also good to mention that going forward, it will now be compulsory you provide your tax ID when you are opening an account with a bank, with a stockbroker, with a pension fund administrator, because the government wants to be able to know, using your tax ID, be able to track your transaction in all these financial services platforms, so that they can be sure that you've paid appropriate taxes. In my subsequent presentation of videos, we are going to go into in-depth discussion of personal income tax, but this is just an overview or an introduction for you. The other bit is also the key changes to expect from the company income tax. Small businesses will be exempted from company income tax if your business that have a turnover of 50 million and your total asset is not exceeding 250 million. If the turnover you have is less than 50 million, your turnover is less than 50 million, and you have an asset that is less than 250 million, you will not pay company income tax. And also going forward, the Act has introduced what we call the development levy. 4% of your taxable income will be charged as development levy. And this development levy has now replaced our tertiary education trust fund. We no longer have tertiary education trust fund. Our old IT levy has been replaced. The LASEMI levy has been replaced. The NPTF levy has been replaced. You just have only development levy to pay, and you will not need to pay any of these other ones. 4% development levy and development levy will be applicable on your taxable profit. Large companies will need to pay 30% corporate income tax. Going forward, large companies will pay 30% corporate income tax and then 4% development levy. Then the new act introduced what we call the minimum effective tax rate for big companies, for what we call multinational companies, which are companies that make more than 50 billion in turnover. If you make more than 50 billion in turnover as a company in Nigeria, your effective tax rate cannot be less than 15%. Your effective tax rate is calculated as your tax payable over your profit before tax. So by the time your tax payable, which is your company income tax and development levy, is compared to your profit before tax, it must not be less than 15%. If it is less than 15%, you need to pay extra taxes to arrive at the minimum of 15%. This is being done or introduced in line with the OECD general requirement or minimum tax payable across jurisdictions of 15%. The capital gains tax has also been increased from 10% to 30% for companies. And yes, there are also some clauses as to which set of companies this is applicable to. We will talk more about this in our subsequent and detailed video when we look at the chargeable gains on assets. Then this act is also trying as much as possible to ensure that digital assets, crypto, Bitcoin, that you pay capital gain tax on all of these transactions, and there are some specific provisions in this regard in the full act, which we will also cover in our subsequent video. What I will tell you is that get ready and join us. You need to subscribe to our channel so that you can follow all these series of videos we are producing in respect of the new Tax Act 2025 as we take a detailed look at all the requirements of this act. Thank you very much, and I look forward to you watching our subsequent video. Please remember to subscribe, remember to follow us, and I look forward to presenting and educating us more on the new Tax Act. Thank you.